Revenue growth is positive, but NOI underperformance is concerning. What do you believe are the main operational weaknesses?
I believe the primary issue is flow-through efficiency. Although revenue increased, a significant portion was offset by rising operating costs, particularly labor and utilities. In addition, banquet business contributed strong top-line revenue, but the margin mix was lower than forecast due to higher service staffing requirements. From a financial control perspective, we need tighter expense discipline and stronger labor productivity management to improve profitability conversion.
Which KPIs should ownership pay closest attention to right now? From an ownership perspective, I would focus on 5 critical KPIs. First, NOI remains the most important indicator of asset profitability. Second, GOP margin helps measure operational efficiency. Third, RevPAR index is essential for evaluating market competitiveness. Fourth, payroll ratio should be monitored closely given ongoing labor inflation. Finally, guest satisfaction scores remain important because they directly impact long-term pricing power and asset value. What immediate actions can we take this quarter to improve NOI?
I would recommend focusing on 3 immediate priorities. First, strengthen payroll optimization by reducing overtime and improving scheduling efficiency. Second, improve ADR quality by targeting higher-rated corporate and premium leisure segments rather than heavily discounted business. Third, tighten departmental expense controls, particularly utilities and operating supplies. Additionally, we should continue monitoring procurement contracts to identify further cost-saving opportunities without compromising guest experience.
What investments would generate the strongest ROI over the next 12 to 24 months?
In my view, the highest return investments would fall into 3 categories. First, guest room technology upgrades such as smart room systems and enhanced in-room entertainment can strengthen guest satisfaction and ADR positioning. Second, energy efficiency projects, particularly HVAC optimization, could deliver meaningful long-term utility savings and improve NOI flow-through. Third, upgrading banquet and meeting facilities would support higher-rated MICE business, which remains one of the strongest revenue growth opportunities in this market. These investments not only improve profitability, but also help protect long-term asset value.
Why should we continue investing heavily if margins are already under pressure?
That's a very valid concern. However, in luxury hospitality, maintaining product competitiveness is critical for protecting long-term pricing power and market positioning. Strategic reinvestment helps sustain guest satisfaction, brand standards, and ADR growth potential. The key is ensuring that capital deployment remains disciplined and focused on projects with measurable operational or revenue impact. In other words, investment should support both short-term profitability and long-term asset value creation.
Why is payroll higher than benchmark?
Several factors are contributing to payroll levels remaining above benchmark currently. First, luxury hospitality operations naturally require higher staffing intensity due to elevated service standards and guest expectations. Second, recent occupancy recovery and banquet activity increased overtime exposure and operational manpower requirements faster than initially forecasted. In addition, labor market pressure and wage inflation continue affecting payroll structure across the industry. That said, we are actively reviewing scheduling efficiency, productivity ratios, and workforce optimization opportunities to improve alignment progressively without compromising guest experience.
How does our RevPAR index compare with competitors?
Overall, our RevPAR positioning remains relatively competitive within the market segment, although competitive pressure has intensified recently. Performance varies depending on business mix, seasonality, and corporate versus leisure demand patterns. We continue monitoring market share, ADR positioning, and occupancy penetration closely against the competitive set. Maintaining strong service quality, pricing discipline, and direct business growth will remain critical for strengthening long-term RevPAR index performance.
Can departmental productivity improve further?
Yes, I believe there are still opportunities for further productivity improvement through process optimization, stronger forecasting visibility, and better cross-department coordination. Technology support, workforce flexibility, and operational planning improvements can also enhance efficiency significantly. However, productivity initiatives should remain sustainable and balanced with service quality expectations. In hospitality environments, long-term operational consistency is usually more valuable than aggressive short-term cost reduction.
Should we postpone renovation projects?
I believe renovation timing should be evaluated strategically rather than postponed automatically. Certain projects may be deferred if they have lower operational urgency or limited short-term revenue impact. However, delaying critical guest-facing improvements or asset preservation projects for too long could negatively affect market competitiveness, guest perception, and long-term asset value. The decision should balance liquidity management, operational priorities, and long-term positioning carefully.
What is the expected payback period?
The payback period depends heavily on project scope, market recovery pace, and the hotel's ability to strengthen ADR, occupancy, and overall guest perception after renovation. In luxury hospitality, renovation investments are often evaluated not only based on direct financial return, but also on brand competitiveness and long-term asset protection. Projects improving operational efficiency or energy performance may deliver faster ROI, while larger guest experience upgrades often create longer-term strategic value. From an ownership perspective, both financial return and market positioning should be considered together.
How quickly can NOI recover?
NOI recovery will depend on several factors including market demand growth, ADR recovery, operational efficiency, and cost discipline. Occupancy recovery may occur relatively quickly in stronger market conditions, but NOI recovery often takes longer because payroll, utilities, and inflationary costs remain elevated. Strong business mix management, pricing discipline, and productivity improvement will therefore remain critical. Overall, I believe recovery potential is positive, but sustainable. NOI improvement will likely occur progressively rather than immediately.
How aggressive should pricing strategy be?
Pricing strategy should remain competitive and flexible, but still protect long-term rate integrity and brand positioning. During softer demand periods, targeted tactical pricing and value-added packaging may help stimulate occupancy. However, overly aggressive discounting can weaken ADR recovery profitability and market perception over time. The objective should be maximizing total revenue contribution and long-term revenue quality rather than focusing solely on short-term occupancy gains.
What operational risks concern you most?
The main operational risks currently include labor pressure, service consistency, cost inflation, and market demand volatility. In addition, operational disruption during renovation activity and supply chain instability continue requiring close monitoring. From a financial perspective, maintaining balance between cost discipline and guest experience remains one of the most important operational challenges. Strong forecasting visibility, cross-department coordination, and leadership alignment will be critical for managing these risks effectively.